Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets where the S&P 500 again hit a record high. Ross takes a look at gold, crude, the U.S. and Canadian dollars, and Bitcoin. Publisher of the trendletter.com, Martin Straith, tells us about whether the U.S. government shutdown has influenced the markets. He also looks at what could be a predictor of future market trends and what's happening with Bitcoin, gold, uranium, and DeFi. Publisher of the VR Trader newsletters, Mark Leibovit, joins us from Arizona to chat about what could affect the markets going forward. He's a big fan of what's happening with the metals right now. Mark also has a special offer for our listeners. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be with you as usual, Jim.
How would you describe what happened on the stock market this week?
Well, one small hiccup a week ago, and on we go again. The Dow, the Dow is just a big high today. But the S&P and NASDAQ at new all-time highs again. So, this market is doing well. That little hiccup we had, the supports of 10 days ago now should be viewed as significant. You don't want to let those be taken out. Otherwise, it would be time for a deeper correction. But, every move we've had since the April low has held at the 20-day average, including the one that we just saw. So that's the line in the sand for the traders. For the long-term investors, you've got a seasonal period here in October that invariably has produced good lows from which the market does rally. So let's see if it sells off to create that buying opportunity.
What's going on with gold?
Gold, there's one that had a really good move once again. We're looking at new highs there. We're trading around 38.80 today. Now, as the gold market moved out of that consolidation period, that was a period from May through the end of August when it was stuck around the 3,200 to 3,450 level. Measurements of the depth of that move gave us upside targets of 3740, 3880, and then 4100. So we expected a pause at 3740. We saw that for about 3 or 4 days. And now we've reached the secondary move of 3880, and we've had a 3-day pause here. But the measured target out of that consolidation is up around 4100, and I still think that that is in the cards. And we'll watch pretty closely to see what type of consolidation or correction we have after that. The thing to be aware of is that if the corrections are really mild, say holding around the 10-day average and start to come alive again, then that would be indicative of the big breakouts runs that we saw back in 1979 and 1973, where you end up in an exponential phase to the upside. This one has not yet entered that phase, but if it starts to push through the 4100 with some steam, then it truly could do that. And we have some upside measurements that for subscribers that are pretty darn interesting.
What's happening with crude?
Crude 7-month low this week, and the seasonality is for the market to find a low in October through January. And at this point, this is, with this move, it could be just the beginning of the expected decline into the seasonal low. We'll be watching pretty closely. If we can get weekly buys, if it can go down enough to produce oversold signals on the weekly, and we would need about another 7 or 8 weeks here on the downside to do that. But if we were to see it have a continued move of that duration, that could produce just a really good buying opportunity. But, at this point, the easy move out of this consolidation is probably to the downside.
What's going on with the U.S. and Canadian dollars?
U.S. dollar bounced really well into about 10 days ago, and that actually is part of what put the small pullbacks in gold and silver into place. We're now at 97.70, and if it was to push through 98.5, then that would be quite bullish. Then it would make this whole consolidation that we've seen in the last few months clearly become a base, and the upside potentials could be quite good on the upside. Now, if we take a look at the other currencies, most of them have rolling tops, just like we've seen this rounding bottom in the U.S. dollar. But the weakest of the whole bunch is the Canadian dollar. That one continues to move to new lows here, while the others are holding in the last few days. But when we take a look at the interest rate spreads between Canada and U.S., the short-term rates, the 1 and 2 year, where the hot money goes, right now, the money sees no reason to come to Canada. And if anything, when we look at commodities versus the Canadian dollar, we look at crude versus the Canadian, it has continued to show weakness there. So there's no reason to be bullish at all in this currency.
What's going on with Bitcoin?
Bitcoin, we had a really good oversold reading here 2 or 3 weeks ago with one of our springboard signals. So that's an oversold and a rising trend. And it also was a sequential 9. So that was 9 consecutive days with lower closes. That produced the low, and the low was in place 1 week ago. And we've seen from there pretty dramatic action. We're up to 122. We had been down around 108. So that's a big move. It's up, retesting the all-time highs. And, the easy move now is to the upside. Now, once we see one of these oversold readings, you typically will look for a 50 to 60% retracement rally and then some resistance. In this case, it's just plowed right through that. So there's an uptrend now in motion, and you don't want to be fighting that one. You want to enjoy the play while it's moving along. When we look at other areas, we take a look at some of these credit markets, in particular the high yield bonds, the CCCs, and the HYGs. They put in highs a couple of weeks back, paused a little bit, and they're coming back to retest the highs, but have yet to break out. And if we take a look at our bank trading guide, that one has just plowed here through to new highs, and it is quite as supportive to the marketplace. If we take a look at the spreads within the CCC, then it's bouncing off the lows and looks as though it might be coming out to some resistance levels. But for now, anything on the credit side of the equation, for all that we might see a correction in the equity market, there's no reason to think that it would be the beginning of anything other than a, quote, correction. So A move down of maybe 5 to 7% would become a new buying opportunities for equities.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Martin Straith next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News Online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, Jim, it's always a pleasure chatting with you. Thanks for having me on.
The U.S. government has shut down, yet the stock market doesn't seem to care. What's your take on it?
Well, yeah. Well, not only did the market not seem to care, but it keeps closing at record or near record highs this week. So, I think that investors, they see these events, as temporary political disruptions. They rarely have any significant or lasting effects on things like corporate earning or the broader economy. So, we know government data is affected, but certainly in the last while, it's been pretty clear that much of that government data is pretty questionable anyway. So, how critical is it and how badly do we need it? I haven't cared about the jobs data for years because it's always been revised in the months after and, usually revised much lower. We just saw a month or so ago, the fiscal year ending in March, the Bureau of Labor Statistics, they revised their employment data down, 910,000, I think. That's such a large downward revision, that just adds to the, increased skepticism, amongst investors and certainly the policymakers now, regarding the accuracy and the reliability of the government data. So, and, the other thing, I guess, is the reason the markets aren't that worried is, most of the government jobs that matter are classified as essential services. So, the impact of these other jobs seems to be pretty insignificant. At least to the investors.
The S&P 500 just keeps setting new highs. Will it ever end?
Yeah, my God, what a tear it's been on. Thursday, the S&P just it hit its 30th all-time high of the year. What are we at today? We're up. It's been pretty flat here, so we're up about 45 cents, I think. So pretty flat as we get to the close. So one of the interesting things to me is that 30% of the total U.S. stock market is now held by foreign investors. So that's totaling over $20 trillion of foreign investment there. So now we've got many indicators that certainly are saying the stock market is overbought. We've got relative strength right at 70, and that's kind of the level where, you start saying that's overbought, technically. The price to peak earnings is at 27.7. So that's the highest it's been since the .com crash. So that's something to keep an eye on. You've got the Conference Board leading economic indicator. Now that's now back to signaling a recession in the U.S. So that's interesting. But again, these things don't mean that the stock market cannot go higher because it's been relentless here. So even though the S&P hit just another all-time high, the fear and greed index is just slightly into the greed range, so that's not extremely overbought. You got the VIX volatility sitting at 16, a little over 16 right now, so that's not at an extreme level. Now you've got the 10-year yield. Now that's been dropping since May, so it's now down to about 4.10%. So that's down from 4.55%. So, lower rates tend to be supportive of the markets. Now, we've got the S&P is pushed through, just on a chart, it's pushed through its ascending wedge pattern. So if people can visualize that, you've got a wedge pattern that's, tilting upward. And the upper rung of that wedge pattern goes all the way back to the .com era at 2000. And the S&P 500 is just pushing through that right now. So this is a big test right here. So the market's overbought basically on a technical term, but it's been that way much of the last month and a half. So far, every pullback has been a, buy the dip opportunity. So we'll see what happens on the next pullback. Again, though, the S&P 500 is in a very strong uptrend. Right now, it's trading at, we got 67.20. So again, slightly positive for the day. Near-term support would be at 6,600. So, right now it's continuing to go up. We're really going to watch 6,600. If we have a break there, then we'll start to take notice.
You posted a chart on Meta on X this week suggesting it may be a leading signal of a potential market correction. Can you explain that?
Yeah, well, you know what? When we're always looking for trend changes. When the market's going up, as long as it's in its uptrend, and especially if it's in an uptrend channel and it keeps riding up, that's great. But when typically when you see a market turn, it is typically the sector that drove the market higher that will also lead the market lower. So that would suggest that we want to keep a close eye on the semiconductor sector, and certainly NVIDIA specifically, for any sign that we're going to see a top in this bull market. So, and there has been some warning signs that we've seen out there. So the chart I sent out, so the Meta chart, one of the things that we've seen there is, Meta is one of the Mag 7 stocks, and it has just signaled that it may be starting to roll over here. So it formed a head and shoulder pattern. Now for your listeners, rather than me describe it, they can just go onto X, to our handle. It's at the trend letter, and you can have a look at that chart. It's pretty clear what's happening there. So, a head and shoulders pattern is no big deal unless the neckline is broken. And that's why I sent out the chart, because the neckline for the Meta chart just broke this week. So now Meta, it could rally again and push back up above that neckline. But right now it's below it, and it's lower again today. And the big key here is if it doesn't, move up and back above that neckline and continues to move lower, that certainly gets our attention. And now another chart that we're watching is Netflix. Now Netflix is one of the FANG charts. So, you got Facebook or Meta, you got Apple, Amazon, and Google are part of that FANG with Netflix. And again, it's another one of these tech darling stocks that help fuel that big rally in the stock. But ever since July, Netflix has been in a descending wedge pattern. So this is a wedge pattern that's trending downward. And just this week, Netflix fell below the lower rung of that wedge pattern. And that's a bearish or negative signal. So if that trend continues along with the Meta trend, then we're likely starting to see a potential breakdown here. Now, obviously, the key chart we want to watch in this whole semiconductor one would be NVIDIA, sorry. So you got, Meta and Netflix, they're definitely key parts, but, NVIDIA is the real darling here. So we're watching NVIDIA closely, because if it breaks down, that would likely signal a top in the bull market. Now, the key here is NVIDIA has not broken down here. So Netflix and Meta are starting to roll over, and NVIDIA hasn't done it. And in fact, yesterday, NVIDIA made another all-time high. So today it's down a little bit. It's testing the upper rung of its ascending wedge pattern. So its wedge pattern is heading higher. So today NVIDIA is trading at about 187. We would need to see it fall below the lower rung of its ascending wedge pattern, and that level is about 178. So a break there would open the door for a drop to about 165. And if we got that, I think that would start to create a bit of panic in the stock market. But again, that has not happened yet, at least not yet. But it is something that certainly we're keeping a close eye on, because that could, give us a potential top in this huge bull market.
Last month, you highlighted despite promoting capitalism, President Trump has overseen significant government investment in private companies, like a 10% stake in Intel. What is happening there?
Yeah, this is, like I say, this certainly caught our attention last month. Trump, this administration is really contrasting, the classic capitalist ideals of, minimal government interference. So now, while certainly not as direct as in China, but it certainly does appear to be quite a shift here. He's got the U.S. government, like you say, took a 10% stake in Intel. They've taken a 15% stake in a rare earth mining company, MP Materials. They've taken a 5% stake just this week in Lithium America, including a 5% stake in Thatcher Pass Mine. They're also looking, we saw yesterday, they're looking to buy equity positions in Australia's critical mineral companies. When he allowed U.S. steel to be sold to Nippon, Trump secured what they called a golden share. And that's where the U.S. government has veto rights on a number of corporate decisions. So the U.S. government now can veto things like factory closures, production cuts, job relocations, etc. So again, it's not quite China's communism, but it's a severe departure from free market principles. And, I suppose what Trump's really doing is probably closer to kind of setting up a sovereign wealth fund. But we're in really interesting times here, Jim. I think as investors, though, we need to be nimble here and understand that things are changing and we need to be able to react. What Trump's doing is he's trying to reverse what the free market resulted in, all this offshoring of these critical industries. So I get what he's trying to do. Personally, I'm pretty tired, I think many people are, of listening to Trump and his daily or even hourly rants. But I certainly understand the concept of what he's trying to do of reshoring these industries. But I'm not, to me, I'm uncomfortable with this kind of state-directed capitalism. And again, it just starts to feel a little bit too much like China. And the key to me is that by simply focusing companies to do what you want them to do, that's not capitalism. Now, you could argue, well, so what? The key is, how does this play out? To me, if you force companies to move their production to the U.S., what happens to the price of these products? How much higher, would a $300 pair of Nike shoes cost if they had to be made in the U.S.? What are we talking, $600, $800? Now the argument for Trump is that these changes are for national security. He wants to buy rare earths for the military, which, you can understand that. China controls 97% of the processing of rare earths. But if you mine and produce them in North America, how much will the price go up? As obviously labor over here is a lot more expensive than in China. And let's say the price of rare earths triple. Well, then are you going to force companies to buy North American mined rare earths? And how much does that affect things that also use rare earths, things like electronics? So we're talking, mobile phones, computers, aerospace, etc. So as I say, things are changing, and as investors, we need to accept it and invest accordingly. I've often said that, we've watched a lot of, we listen to China and what they say they're doing, because they do what they say they're going to do. A while ago, they said that they're going to sell U.S. bonds and buy gold. That was one of the main reasons that we told our subscribers we're buying gold. And those recommendations are up well over 100% in not a very long period of time. So now, whether or not you like Trump, you better listen to what he plans to do and what he wants to do if you want to make money in the markets, because he seems pretty darn determined to do what he says he wants to do. And to me, it's like it's kind of like after the financial crisis in 2009. We had Bernanke and the Fed. They introduced their near zero interest rate and quantitative easing. Well, what was the result? The result was a decade of, everything going up in the stock market. Many of us thought like that whole zero interest rate policy was crazy and it would probably destroy the currency, but it did juice the stock market. And for that decade, the mantra was, don't fight the Fed. Well, now I think the new mantra is, don't fight Trump. You can disagree with what he's doing, but don't make your investment decisions based on politics because, in 2010, the only play was lower interest rates and that goosed the stock market. Now you've got Trump. He's aiming to get interest rates low. Plus, he wants to use fiscal tools, just like we're just seeing here, of buying stakes in private companies. He's adopted this interventionist policy where he's inserting the government as a shareholder and a decision influencer in many of these key companies. So his approach can be seen as, a guarantee of corporate success in certain sectors by government ownership and influence. So again, as an investor, you need to be aware of this. You can disagree with it, but man, it's happening. So while the Fed has been the engine behind the 2010 decade-long market rallies, you've got Trump now actively steering parts of the economy, by taking ownership in key companies to protect strategic interests and to shape industry outcomes. So it's a huge shift. Trump will soon have control of fiscal and monetary policy. And if he does what he says he wants to do, it's going to be very bullish for stocks here. So I see a real shift, taking some of the semiconductor profits. I can see people, if we see, you got Netflix, you got Meta, if we start seeing NVIDIA start to roll over a bit, I can definitely see people going, wait a minute, why don't I take some of the profits? You don't have to take all of them and move them to somewhere that's undervalued. And now we're talking commodities. I just checked with Perplexity. That's an AI tool. The global market cap of the entire mining sector, so think of the entire mining sector, is 1.2% of the global stock market capitalization. So if we were to take a tiny migration of profits from these other very profitable sectors like semiconductors and put some of that into the mining sectors, that would push these stocks dramatically higher. So to me, this all means, again, looking at commodities. So I'm talking rare earths, I'm talking copper, base metals, oil and gas, uranium, and Trump wants, what he's doing here to me seems very inflationary. So now you're talking gold, you're talking silver, platinum, palladium. Those should do well. Again, another area you want to look at is Bitcoin and the whole DeFi. Those are sectors that you really want to take a strong look at. So again, whether you believe it's the right thing or not, he's doing it. So as investors, we need to be aware.
What do you see for the U.S. and Canadian dollars?
Well, I always say with currency, it's always connected. You can't isolate the one currency from another. If the U.S. dollar is rising, virtually every other currency is going to decline. When the U.S. dollar is declining, the other currencies rise. That's just the way it is. So from its low in July, the U.S. dollar has been in a slight uptrend. So it's very slow. But again, in the big picture, so many people go, oh, well, the U.S. dollar is dead. It's done. Well, what's the alternative? The euro, the yen, the Chinese yuan? Seriously, like in the big picture, all trade-weighted currencies they lose purchasing power together at about the same rate. So again, the U.S. dollar is still the reserve currency. Certainly you've got the BRIC countries. They're trying to wean themselves off the U.S. dollar, but that's not happening overnight. That's going to take years if they ever do it. So while it's going to be under pressure, with rate cuts, etc., so will all the other global currencies. The U.S. dollar is the least ugly house on the block. And, there will be fluctuations for sure, but, when things get nasty and things get changed and things get challenged, we always see the U.S. dollar be the place to go to. Now, like I said, everything's all connected. If we look at the Canadian dollar, you've got, again, the U.S. dollar has been rising since July. Well, guess what? The Canadian dollar has been declining since July. The Canadian economy is much weaker than the U.S. Our unemployment rate is, it jumped up to 7.1%. That's the highest it's been since 2016. Well, the U.S. rate's only at 4.1%. So that's a 3% difference. The Canadian dollar right now is trading at 71.68. Next support would be 71.25. Again, Jim, as I say, it's all connected, heavily driven by what's happening with the U.S. dollar. And again, if the U.S. dollar continues to rally here, and if it picks up steam, you're going to see the Canadian, the euro, the yen all decline.
What's your take on gold and silver?
Well, it's been impressive. I mean, for all the hype, over artificial intelligence and, the big surge in chip stocks this year, the gold miners have actually been the better buy. The gold ETF is the GDX. That's up 130% this year. So since January, compare, you got the semiconductor SMH, the semiconductor ETF. I mean, that's up about 80% since April, but it's only up 32% for the year. So right now, today, gold's sitting, it's up about 44%, $44. Again, another day, another record high here. So after Liberation Day, when Trump announced all those tariffs, gold spiked from, it was trading just under 3,000, and it went to about 3,500. And then it consolidated, and it traded in this really kind of fairly tight range between 3,150 and 3,500 from about mid-April to the end of August. So that period of consolidation, I mean, that was about 4.5 months. And it was like gold was kind of re-energizing itself, getting ready, almost in hibernation, getting ready for its next big move. And that's what we've been seeing now. So gold is in a very powerful bull market here, and that trend remains strong. It is overbought on a number of indicators, but so far, every dip has been bought. I mean, yesterday on Thursday, gold was down almost $50 at some point in the day, but buyers came in, bought it, and by the end of the day, it was only down about $10. And again, today, like I say, it's up about 44, heading for another record high today. So one thing that's interesting to me is we're seeing both gold and the S&P 500 moving up together. And the interesting thing there is the leader, the number one mover in the S&P 500 right now is that gold ETF GDX. So, why is gold rising so much? Again, it's the same thing we've been talking about for months now on your show. Central banks been buying, especially the ones that are not the friends of the West. So you're talking, China, Russia, Iran, etc. You've got governments everywhere. I mean, they're piling up massive deficits in debt. Now, if you look today, if you look at the technicals, gold is overbought here. And one of the things is we get a lot of emails these last month or so, and we get a lot of questions from investors who do not own any gold, who do not have a position, but they wish they did and they want to get in, but they're scared to buy at these elevated levels. So one of the things we've been saying to people is one of the things you can do is you can think about things like dollar cost averaging. So this is where you invest a fixed amount regularly over time, regardless of price. So you just put in a percentage of what you ultimately want to hold. And certainly if you see dips, you can, put it in some there. But basically that method, in times like this, it helps reduce the risk of buying at a peak, and it smooths out the kind of investment cost over all these fluctuations. So it's something to consider again for those who missed this bull run. Now, based on seasonality for gold from October to December, we're typically in a strong period. Again, last I looked, gold's at 382 or 38.82, so it's up about $44. If we get a pullback soon, the key to watch would be support about 3,700. I mean, if you can get a pullback to 3,700, that would be a time to maybe add to your position or start a position. And long term, I'm really bullish gold long term. If we look at silver, again, making new highs. Today it's trading at we got here $48. So silver's up about 65% this year. I mean, again, $48, that's the highest it's been since 2011, when it was trading about $50. So we're getting very close to that level. So again, it's supported by, you got a combination of tight physical market conditions, rising industrial demand. So, you got the electrification of everything, macroeconomic factors. So you got lower real yield rates, had the softer U.S. dollar. But like gold, silver is technically overbought here. So we could see a pause before the next big spike. But again, we are totally confident that we're gonna bust through that $50 level, and probably quite soon.
The last few times you've been on, you've been calling for oil to drop below $60. Is that still your take?
Yeah. Well, from August through to late September, oil's been trading in a range from just under $62 to $65. But this week, it broke below that support at 62. Today, we're looking at here $60.70. So this week, we had word that OPEC is looking at increasing production by 500,000 barrels per day starting in November. So again, that's just bringing on more supply. So that's negative for price of oil. So what I said for the last month or so is that if geopolitical tensions remain calm, then I definitely expect to see oil below $60. I'm looking at, the mid to low 50s as possible, especially if we do see a rally in the U.S. dollar. Then I'd be looking maybe Q4 and Q1 of 2026. We should start to see oil move up. So numbers I'm looking at here are a drop below 60, likely testing the bottom, the double bottom we saw in April and May. So that was in the $55 to $56 range. So you say, well, what could change that forecast? Again, we always have to be prepared for some escalation of tensions, whether it's in the Ukraine, Middle East, or Taiwan. We have to remember too that, a month or so ago, we saw that China do the big military parade. China, Russia, Iran, North Korea, they've formed this CRINC alliance, they call it. So, again, any major escalation of any of those conflicts, certainly that would give oil a boost. But as I say, if things remain fairly calm, I expect to see oil in about the mid-50s sometime in the next month or so.
What's happening with uranium?
Well, uranium prices are doing well again. So just closed about 82. So that's an 18-month high. We've got the U.S. government. They've signaled they're going to create a uranium strategic reserve, similar to what they do with oil. That's very positive for oil or uranium prices going forward. Uranium stocks have done very well since April. The thing that is so bullish to me for uranium is there is a supply shortage, and for a nuclear facility, they have to place orders now for delivery years out. And the other real key here is the price of uranium is a very small percentage of the operating cost of a nuclear reactor. And let's be realistic, they don't have any option. The price could double, it could triple, and they would have to pay for it. Even though the price dropped from 106 down to 63 from February 24 to March 25, uranium has remained in its longer-term uptrend channel. So, it's even though it had that fairly significant decline, it remained in that uptrend, and now it's been moving up again. So, we're just really big believers in nuclear and uranium for investing. And again, any pullback, we will be looking to add to our position.
Natural gas has had a good week. What's happening there?
Yeah, it has. From early July to early, say, mid-September, the natural gas formed what's called a cup and handle pattern. And for those who don't know the term, the cup looks like a rounded U shape on the chart. And it's created when the price drops, then it stabilizes, and then it recovers back close to its previous high. So you can visualize that U-shaped cup formation. And then the handle forms when the price experiences a brief or shallow pullback, and typically drifting down before consolidating and setting up for a breakout. So what we look for a breakout would be above the handle's resistance, and that would be a buy signal. And it's often accompanied by increased volume. So a few days ago, natural gas did break above its handle of the cup and handle. So that was about $3.15. And it's now pushed above $3.50. So initial resistance here would be about $3.65, and then we're looking at about $4. Now, something investors need to remember with natural gas is often called the widowmaker, and that's because it's so volatile. It has these massive rallies and then it has these really sharp declines. So if you're going to get in natural gas, you want to get in, but you want to prepare for have your sell stops. So we need to see if it can break above that 365 resistance. And if it can, it's potentially going to test that $4 level. And a breakthrough to $4, that opens the door for a big run up to $5.
What do you see ahead for Bitcoin and Ethereum?
Well, yeah, lots of action going there too. So the big thing all investors need to remember with crypto is volatile. So Bitcoin has been, it's done very well since we had the liberation and all the tariff uncertainty. It rallied from that Liberation Day low, about 77,000. And it went into it was about 110, 112,000, I think, in late May. Consolidated back to about 100,000, and then went to about 112 in May till mid-July. And then it broke out to its all-time high at about 124 in mid-August. But since then, it's pulled back. But this week, Bitcoin's had a big jump. It's up about $2,000 today, trading at about 123,000. So just under its all-time high. Something that investors need to understand now, Bitcoin's been around for a while, so there's a bit of history. October has been dubbed Uptober for Bitcoin because it has averaged returns of 20% in October and 60% in Q4. So, seasonality-wise, this is the time for crypto. It's certainly for Bitcoin. Now, uncertainty from the U.S. government shutdown, that's delayed economic reports. That's increased expectations that the Fed may have to cut again. And again, that just makes riskier assets like Bitcoin more attractive. You've got increased institutional participation. You've got large inflows into Bitcoin-focused funds and ETFs. I mean, just in the last few days, we've seen over $1 billion go into Bitcoin funds and ETFs. So we do expect Bitcoin to become, more of a haven play, along with gold. There's a realization, again, with so much government debt globally, all fiat currencies are dramatically losing their purchasing power. So, like I say, Bitcoin is challenging its all-time high again here. So keep an eye on that. Bitcoin moves around a lot. If you're a day trader or if you're a swing trader, there's some great moves you can make in there of, buy up, let it pull back to certain, and that's what we do. We talk about these different levels every week. And then, and if you're a longer term investor, when you do get some extreme rallies, sell some, take some profits. So if we look at Ethereum, similar to Bitcoin, October, very strong seasonal period. Decentralized exchange, the DEX exchange, its volumes in Ethereum surged about 47% now, week over week. So that's reflecting really growing demand and uses of that network. So again, that supports price increases. And as we discussed on your show in July, Ethereum, as the companies were starting to create these Ethereum treasury strategies. So that all kicked into helping Ethereum. But, it also, we've seen institutional players. But Ethereum fell out of its uptrend channel in early September, and it tested we had a key support level of 3,900, and it hit that right on the button, and it has been rallying ever since. So far these key support levels we've been identifying have been pretty spot on. And now since that, hitting that support level, Ethereum's been on a nice run here. Today it's trading at, what do we got here? 45.25 right now. So again, both Ethereum and Bitcoin are in a nice run right now.
Any updates on your new DeFi Digest newsletter?
Actually, things have been fairly quiet lately in the DeFi space. We're seeing lots of consolidation happening right now. Most of the assets have been kind of trading sideways, low volumes, just kind of maybe catching their breath a little bit here. The good news for your listeners is that we're keeping our powder dry, getting ready to pounce on the next development, as opposed to chasing kind of the old news. So just for your listeners that really aren't familiar with this space, we're talking about DeFi. Really, we're talking about decentralized finance. Again, that means, blockchain technology to deliver financial services directly. So that means without intermediaries such as banks and brokers. So anybody with an internet connection can access DeFi. So no paperwork required, no accounting, opening. You don't have to open new accounts. No traditional gatekeepers like banks are involved. So it runs on decentralized networks. So we're talking things like Ethereum, and it uses smart contracts. So those are code that automates and secures transaction between different users. So the opportunity here is huge to me. And you've got mainstream banks like BlackRock. They're predicting that there's going to be between $15 and $30 trillion market for real-world assets in the next decade. And when we talk real-world assets, we're talking things like government corporate debt. We're talking about commercial real estate. We're talking things like fine art, commodities, you name it. I mean, it could be a Van Gogh painting. It could be to a commercial building. It could be a racehorse. We've seen all of that stuff happening. So we're moving these transactions on the DeFi platforms. I mean, that's the next logical step in this progression of, being automated on how we do things. Early adapters, people that get into this early, you've got the opportunity. There's no guarantee, but you've got the opportunity to capitalize on this shift. And it's very similar to what we saw, when the internet first came in and Bitcoin. The early adapters there did very, very well. Now, again, just like with Bitcoin, there will be a learning curve. You're going to have to learn new technology and new terminology. DeFi investors, you're going to have to learn how to master things like, digital wallets, private keys, smart contracts. But I mean, that's why we created DeFi Digest, the newsletter, because it's going to cover all those developments. It's going to help educate, provide guidance to help subscribers work their way through the whole evolution of this new financial revolution. So, it's free right now. I mean, like I say, the learning curve exists. But if you're somebody who enjoys exploring new technologies and you want to be part of this game-changing revolution, check out DeFi Digest, start to learn about how this is all working. And simply, if you're interested, just simply email us at info@thetrendletter.com and we'll put you on the list. And again, we're not charging for the service for the next few months. We will eventually, but right now we want to get people's feedback because we really want to make this the go-to DeFi service.
Can you tell us a bit about each of your services?
Yeah, well, we've got 6 services now. So we've got 3 paid services and then 3 free services. So the paid services, you've got Trend Letter. So that's in its 24th year now. Publishes weekly for long-term investors who want to understand really what's driving the market. So kind of the things we've just been talking about today here. Why are things happening the way they're happening? What's the most likely next move? What are the trends? How close is the trend to be broken? Because that's when you really want to get in or get out of a market. Trend letter covers all sectors: equities, currencies, precious metal, commodities, and bonds. The next one is Trend Technical Trader. So that's an online service updated every Monday, Wednesday, Friday, and more often if there's something else happen. It's for both active and long-term investors. It started as a hedging service, but it also now covers long positions and sectors like equities, precious metals, commodities, and it includes our proprietary gold technical indicator. Now, by the way, so the trend letter is about $600 a year. Technical traders about $650. Trend disruptors, that's for speculators with risk capital. So it's a service that invests in disruptive ideas. We're talking AI, virtual and augmented reality, 5G, cloud, Internet of Things. Again, so that's about $600 a year. And then our free services, DeFi Digest, which we just talked about. We got Market Pulse. So that's a market recap highlighting key market moves that happen in any given day and or the week. And then our third one is Headlines. So that's a free daily service. That's where we review what's happening in the markets each morning. And then we send out headlines that we think investors should be well aware of. And then readers can simply read the headline. And then if they want to get the details, they just simply click on the link and they can read the article. So, Jim, if any of your listeners have any questions about our services or what's happening in the markets, they can simply email us at info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
Jim, again, it's always a pleasure chatting with you. Have a great rest of the weekend.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. Coming up, Mark Leibovit, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be here, Jim. Thanks for having me.
Can you tell us about the VR Trader newsletters and how our listeners can subscribe?
Absolutely. It's VRTrader.com, Leibovit VR newsletters. It's all the same company. It originally started way back in 1979, believe it or not. So I've been doing this for 45 years in one iteration or another. And it's a stock market, or I should say all market newsletter, and we have several newsletters, so it's just not one. So you go to VRTrader.com, pull up it, and you'll see all the newsletters from metals resource to blockchain, covering crypto, to our market timing letter. So we've been around a while, and we've had the good fortune of surviving 45 years of markets and still doing it. And by the way, since you brought it up, we might as well offer a discount. We haven't done that for a while. If you do subscribe to VR Trader, any of the newsletters, use the promo code HALFOFF, HALFOFF, and you get 50% off of any of the newsletters.
How is sell Rosh Hashanah and buy Yom Kippur looking?
Well, it worked out pretty well for 3 days. You know, it's based on a lot of historical cycles, cosmic cycles, lunar cycles, and so forth. You know, it's thousands of years of Jewish history, so it's just not something I made up. In any event, there had been some correlations, and as I mentioned, I think in last week's interview, just prior to Monday, we put out that little sell signal warning about sell Rosh Hashanah by Yom Kippur, and last Monday, Jay Powell from the Federal Reserve comes out with a comment, the markets are overvalued in so many words. Maybe that wasn't the exact phrase, but he indicated the markets were pricey, so the market went into a 3-day nosedive, and that perfectly coincided with the Rosh Hashanah theory that we have rebounded back since. So, you can argue, well, it only worked 3 days. It should have worked for the whole week, and I guess that's the variable since the market did reverse after 3 days, and the last 3 days has been moving to new highs. But it did indicate some volatility, and it's something I always pay attention to. So on a trading basis, it worked out for a couple of days. But it's like anything else; you just want to know about this stuff. I'd rather not be caught by surprises. If I see the possibility, I at least want to have it as a variable on my desk.
Do you think the markets will care about the U.S. government shutdown?
Oh, well, it's a party for the Republicans basically right now because, as an expression, it's not mine. I think it was attributed to a famous economist that said, "Never interrupt your enemies when they're making a mistake." And in this particular case, you got the Democrats jumping up and down. I think it was Laffer, Dr. Laffer, the economist, was actually quoted saying that, I think, on CNBC or on Fox News this past week. So, the shutdown plays into the hands of, at least so far, into the Republicans. The Democrats are screaming, and his attitude was let them scream because they're going to probably lose on this one, particularly if Trump starts firing and laying off a lot of government employees, which appears to be, a likely scenario here from what I'm reading. And in addition, billions of dollars in climate grants that were originally functioned as slush money or laundering vehicles for the Democrats have now been canceled by the Department of Energy, I read. So I guess all the money laundering schemes that prop up election rigging and corruption payoffs are being dismantled. This is good news. It means that our tax dollars won't be funneled through these scams in the name of quote-unquote decarbonization or, global warming. So this budget issue that came up this past week could work out favorably in a lot of ways. We'll see what happens. It's been stretching on for a few days, and we'll see if there's a compromise met, but hopefully in the meantime some progress is made on all the crazy expenditures the government has been saddled with for so many years.
Do you think the U.S. government shutdown will allow President Trump to start cleaning up the government? Yeah,
that's what I just was sort of referring to. I think that there's an opportunity, absolutely. So apparently there's a lot of cleanups that still needed to be done that apparently we didn't accomplish under the Doge program, or maybe it's still underway under the Doge program that Elon Musk sort of initiated. So we'll see. We'll see how it all plays out here. Tax savings is good for citizens. If we cut down on overhead expenses and waste, at least the money perhaps could be funneled into something more productive than a lot of these really wild, crazy programs that we read about. I mean, we could probably spend hours if I put together all the research of the kind of ridiculous programs that money was being directed towards in the recent decades, and to win favors and so forth. So it's crazy. Well, we don't have to talk about politics. We understand it's all corrupt in one form or another anyway. Politicians are more concerned about getting reelected than doing their job. So they sign off on stuff which puts money in their pocket or their constituents' pockets versus what's best for the country. It was nothing new. And not only here in Canada, everywhere. It's just an unfortunate nature of politics. But to answer your question, yes, it is a positive, and hopefully you do get some cost cutting.
The S&P 500 hit new highs this week. Now we're into October. Do you think the stock markets can power through what has traditionally been a very, can we say, interesting month?
The phrase, originally I thought it was originated by Joe Granville in the back in the 1970s, 1980s, the expression, the market is climbing a wall of worry, but it might have gone as far back as Bernard Baruch or some others on Wall Street before him. But in my younger days, I heard him talk about it all the time. And I guess this past week or two has been the most classic example of the market climbing a wall of worry that we probably have ever seen, particularly now with the government shutdown underway, with the S&P actually posting new record highs during this process. So, what does it say? It says contrary thinking. What's obvious is not always obvious in the markets. And the expression of my market climbing a wall of worry certainly is, setting another precedent here, which is just amazing. So everybody is scared it usually means you have to think just the opposite. And if they're euphoric, you have to just think the opposite as well. Just the way, I guess, it's human psychology at work.
The Fed lowered the bank rate by 0.25%. The stock market seemed to like it. Do you think President Trump wants the rate even lower?
He does, but, Jay Powell really messed up, and I actually made a small comment about that in one of my recent newsletters. He really had an opportunity to really do some good, and by only lowering interest rates 0.25 point, he did a lot of, it created more of a problem than anything else. He really needed to do the 0.5 point rate cut. And part of the problem is the bankers. We're getting down to banking theory and how banks make money because, they borrow money from the Fed at a ridiculously low rate and they lend it out 2 or 3 times that rate to consumers, or if more, even much more than that, obviously, if you're talking about credit card debt. But this plays into the hands of the bankers, and really was not, the right thing to have done. I mean, basically, this is a chance to really, cut the rate and, maybe cut into the profit of the banking industry, which is really out of control. I mean, in terms of, borrowing money from the Fed at, 4% and lending it out at 8, 10, 12, 15% to consumers. And banks have that ability, as you know, with their ability to multiply the amount of money they can lend out based on what they borrow from the Fed. So I think it was a misjudgment on his part. I think history will point to that. And, so far the Treasury bond market, hasn't been thrilled by his 0.25 point cut. We don't know what it would have done if we did the 0.5 point cut, but the Treasury bonds really haven't been rallying here. And we're talking about the 20-year, 30-year Treasury bonds, which is actually the biggest market in the world, bigger than the stock market. And unfortunately, it hasn't started to move higher, which people were hoping. So obviously, Jay Powell has been mismanaging things to the extent that the bond market did not respond positively. And without the bond market responding positively, really whatever Jay Powell does is meaningless because that's the biggest market. That's where the basis for mortgage rates come from. This is where basis most of big financing is based on. And we really need that bond market up, and that would really drive interest rates down, and that would be the real key. So the 0.25 point nonsense is just a psychological thing, and not in reality the important thing that needs to happen.
While the Fed rate drops, could mortgage rates rise?
They have. That's been the problem. We had a little rally in the mortgage market rates. When I say rally, a little pop in the rally in the bond market for a short period of time, for maybe a couple of days. You saw a little pop there, and that brought the mortgage rates down, but now mortgage rates have gone back up again. So we're not getting the result that Donald Trump is looking for and what consumers are looking for. And, maybe cutting back government debt, firing people, really bringing down expenses. Maybe that'll get in this whole government shutdown event, may play into the bond market rally that we're hoping for. The bond market has to feel that our financial house is in order, which has not been in order. So the closer we get to the financial house getting into order, which is, combination of cutting expenses and, generating more income, perhaps with the tariffs and so forth, maybe that's what we really need to get the bond market moving, rates to come down and have some meaningful results here. So hope I'm really answering the question. Really, we're sort of on the fence here waiting to see how the bond market reacts and what trigger would be for that to happen. And we really need it to happen because the housing industry is sort of in trouble. And people aren't rushing to buy houses. Interest rates are too high relative to what they've experienced. Now, historically, not high at all. I mean, I paid 11% for a mortgage many decades ago when I lived in Chicago. That's when Paul Volcker was in the command seat at the Fed, and we saw interest rates surge to 20%. So there have been times where rates have been much, much higher. And we complain about 6, 7, 8% interest rates, but historically, that's not historically high at all. But still, it's enough to deter people from moving forward in their housing purchases, and I guess some, corporations doing long-term financing that they would like to see. So we're just sort of on the fence here. I'm optimistic it'll all work out, but we'll see how this government shutdown and other factors play in. And of course, there's extraneous factors too. We still have geopolitical issues going on around the world. So there's so many variables here that could affect the change as well. So we're just going to have to monitor it. But I'm leaning more optimistically here, just looking at what the news is saying and what the forecasts are. But like anything else, we're happy that the equity markets are moving up anyway. So maybe the equity markets are telling us, as I'm hoping, that it will be a positive result, because stock prices tend to lead anyway. So maybe we're just all being affected by that wall of worry issue that I just mentioned a few moments ago.
The U.S. dollar recently hit lows not seen since early 2022. Could the U.S. dollar have put in a double bottom in July and September?
Well, let's see if that happens. That the gold bugs out there are going to be too happy, because much of a good part of the rally that we've seen in precious metals and all metals have been tied to the weak dollar. So if the dollar does bottom and take off here, and the dollar strengthens, that's going to put a temporary end to the big rally in the gold market. I think not necessarily long term, but for the short term. So charts are saying it's possible. So particularly since gold itself has gone to record highs and has become almost euphoric to the point that it's way overbought. So I think that is likely to happen. Gold
continues to hit new all-time highs. Do you have targets for gold?
Well, I'm a little nervous about it, as I just mentioned. I think start getting to 3,900 in gold, considering for years we're sitting here when it's trading at $1,000 to $1,500 and not going anywhere. I think if you press me, we've talked about this over the years. I mean, 5,000, 10,000, all these numbers are theoretically possible, but the question is, how long are you going to live? How much patience do you have? I remember buying gold in the 80s at $500 an ounce and thinking it was terrific, and you had to wait and wait and wait, and finally it took off. So it only took about 30 years for the big move to unfold. So, if you're going to live a long time, then stay with it, because it seems like with time it will move higher. Maybe another 30 years, it'll be 10,000.
Silver's close to new all-time highs. Do you have targets for silver?
Well, everybody's talking about the $50 level as the key resistance level. We were talking about this since the Hunt Brothers fiasco decades ago. Will it go back to 50 and take it out? Within demand for silver seemingly unending, and the mentality, it's like anything else. Everybody jumps on board and they get all excited about it, and there's a lot of bullishness about silver right now, a lot of speculation. So, that 50 is certainly a resistance level, and there's some, you can start arguing, well, that's just a resting place, and we can ultimately go to dramatically higher levels. But over the decades, silver has been, there's an expression among traders, they call silver the quote-unquote widow killer, meaning that you can lose more money and wipe yourself out trading silver than probably most other investment opportunities out there. So over the years, if you bet heavily on silver, you usually lost a lot of money in the process. And, just recently, obviously, we're getting this big rally, and, you can't forget, what history says. Is this just another is this another bull trap, as much as we've seen over the decades with silver, or is this time different? So you just have to know when to cut your losses. And, if you got some silver stored in your vault and you've been holding it for years, then I guess you continue to hold it and hope for the best. So, it depends, are you long-term or you short-term? I mean, obviously you had to be very long-term for silver for it to pay off. I mean, you had it for the last 30 or 40 years, back and forth, $50 back to $6, back up again. I mean, that's not a steady progression. You did better in gold, even though you had to be patient there as well, than you did in silver. So, we just have to watch the speculation and the charts on it. I'm not making any long-term projection, just trading it.
Platinum's been putting in new highs. Do you have targets for platinum?
Yeah, we love platinum and palladium too, Jim. All the metals. I mean, the basically the rare earth stocks, uranium, lithium is starting to come back here a little bit. Platinum, palladium, the whole metal group has been, been a recovery phase. And when you think about it, platinum is still cheap. I mean, used to trade, I think, twice or three times the price of gold years ago. I have to pull up the exact numbers. For many years, gold was the weaker sister, and platinum was the premium commodity. So I sort of remember the days that platinum was like $800-900 an ounce, and silver and gold, was maybe $400 or $600 an ounce. And platinum was always at a premium over gold. Well, obviously that's not the case because platinum is only a fraction of that right now. So it's about half the price of gold right now. So it's got a lot of catching up to do. Maybe that's what the market is seeing. But a lot of platinum and palladium and, these rare earth metals are all, a result of industrial demand and consumer needs, and products and so forth. So I guess it depends on how much more of those we're going to need for, producing iPhones or producing, other technology.
Crude is looking weak. Do you have targets for oil?
Well, I've had the same targets for the last year. First I had $55 and then $47. We got to 55 and then we bounced back up to 70 and then we were down the other day and now we're up again today. So much of it is geopolitically related. I'm sort of on the fence here. Officially, I still think there's a chance we can go lower, take out the $55 and maybe get into the high 40s. But if something happens, in the Mideast or some other place in the world, then suddenly that changes overnight. So many of the shares in the oil industry have been better investments than oil itself because companies like Chevron or Exxon and so forth pay dividends and they seem to make money no matter where the price of crude oil is. So I think you're better off in the crude oil stocks than in crude oil itself. But, push to the wall here, I still think with production hopefully continuing to expand. Now, by the way, that may have changed here over the last few days because of the government shutdown. What I'm hearing, certain lease permits and other things may not be able to be initiated because of the government shutdown. So that could put a crimp in the oil industry expansion short term. But outside of that, normally with the expansion, you would think that would put a pressure on crude oil prices. And a lot depends on what OPEC does too. So I'm officially a little bit more bearish, but I'm obviously trying to be realistic about any short-term, change in the news environment.
Looks like Bitcoin is showing some strength that had a high just under $124,000 in August. Do you see new highs ahead for Bitcoin?
Well, we just actually, the actual number, I think, was 123,600, and we actually went to 123,800 today, if I'm not mistaken, looking at the spot market. So we actually made a token new high in trading today. And it's funny, we've been talking about Bitcoin here for the last couple months and, went from 123 down to about 108. And here we are back up again, 123. And we seem to be in a seasonally positive period here. So I wouldn't be surprised if you see Bitcoin continue to move higher and might even see 140,000 or 150,000 here in the fall, and we'll just take it a day at a time. So it's definitely, and Ethereum is showing some life. Some of the other cryptos are showing some life. I think this little move in Bitcoin really surprised a lot of people because it went to that 120, just under 124 you mentioned, and then it sold all the way down, and the bears started to come out of the closet again. And now here it is. It took off in the last 24 hours. Actually, in the last few hours, it posted another high just by a token amount. Now, there's an old expression. I always refer to some of these old expressions like climbing a wall of worry that I mentioned earlier in the interview. But, you can argue that it hit a little trading double top today. The fact that it got to that 123 to 124 range and didn't blast through to 125, 126. Some technical chart analysts, including myself, might say, well, if you see a double top, you sell a double top, and that might be what's happening here. So we have to see it really break through here in the next, I guess, 3 days and just discredit that thinking. But normally when you get to a level like that, then you go back to that level and don't decisively break through it. You can argue that's a little bearish technical event. So we'll have to see how it plays out here in the next couple of days. My gut feeling is it probably will go through and blast off, and we'll see, a little more dramatic move to the upside. But and we are, in our newsletter, do have mentions of long positions and ETFs related to Bitcoin. So we seem to be doing okay on paper there. So I'm keeping my fingers crossed that it breaks out.
How is the fear-greed index looking?
It's sitting in neutral here. It's around 53% on the chart. I just checked it a few moments ago. So it's right sort of in the middle of the gauge. So it's not excessively bullish. You would think that it would be up there at 80, 90, or even 98, 99% with the S&P into new record highs. But it's sort of in the middle there. So maybe the government shutdown the fear of what could happen in the September-October period, which so far has not happened. Maybe that's keeping the enthusiasm down a little bit. So it's sort of neutral right here. It's not at any extreme. So just have to watch it. And I don't necessarily use that as a reliable gauge of the market. Generally, if it's real overbought and you're way up high on the gauge, that's usually bullish, even though you're extended, because that means that momentum is with you, and that's why it's so extreme. On the other hand, sometimes if the gauge index is way down, like 20%, at the 20% range on the scale of 0 to 100, everybody's bearish. That means market's going to go lower because the momentum seems to be on the favor of the bears. So when we're sitting in the middle of the gauge like here, it's sort of difficult to really get a clear reading. But like generally, the point I'm trying to make is when it's an extreme, usually it continues into that extreme because that's where the momentum is at the moment.
Are the real estate markets concerning you?
No, because I think ultimately the bond market's going to rally. There's political pressures involved. We've seen indexes related to the construction industry. Big name like Home Depot, which is in the home remodeling business. These stocks have recovered significantly in the last 3 months. So they're anticipating, a turnaround. So I think the stocks are telling you that despite what we're seeing with interest rates here, mortgage rates, and so forth, you're going to see a resumption of an uptrend in pricing in the home industry. Plus, a lot of builders are discounting interest rates when you buy. I get emails all the time that they're buying down the rates from the banks, so that you can buy a house, here, at least here in the U.S., starting at, 3% or even 2.5% for the first year, and then it goes up a little bit the next year. So with the builders buying down the interest rates, they're giving, consumers a real opportunity to buy at lower interest rates, even though the official rates are not at that level. So the momentum is there. They're going to turn it. I think you're going to see a boom again.
What are you hearing on Russia, Ukraine, and are the markets reacting?
Okay, well, the recent story is, Russia targeted natural gas facilities. That happened today. So a bunch of drones and, huge attack there on Ukraine. And the only other story I saw today was that Putin praises Trump but warns supplying of U.S. long-range missiles to Ukraine will badly hurt ties between the two countries. So that's sort of the official news story out there. And, there really not much else to say other than getting into a long discussion of why we're in this mess to begin with and why Putin even attacked Ukraine, and could that have been prevented by perhaps, agreeing to a potential ceasefire way back, which was turned down, I believe, by Britain and others. So there's a lot of fault, a lot of fingers you can point here who's at fault, and it's not necessarily all at Putin's side, even though he became the aggressor and is being treated that way. He had some due cause and reason for doing what he did if you really read the history of what happened. And he had been lied to and so forth. So people are going to accuse me as being a Putin supporter. But that's not the case. Only if you read the history of what really transpired between the West and Putin in the last 30 or 40 years, you can understand why this whole situation unfolded to begin with. So a lot of it is actually an article that I printed in my newsletter. There's a famous analyst who came out with a whole discussion of the history of Ukraine and the West and what really transpired here from the 1980s to date. And you can see that a lot of the cause of the problem was initiated on our end, not necessarily on his end. If you really read the full report and see what the U.S. has done, what recent history has been in terms of our own actions in that part of the world. So, getting into a long discussion about, we're just going to have to wait to see how this all plays out. But it seems like Europe is gearing up for war. They have economic problems. And I think it sounds like Europe needs a war to pull itself out of financial issues, great, significant debt and so forth. So, the war hawks are pounding the table in that part of the world, and hopefully it doesn't go to the extreme, which at the moment appears likely. But we can always pray for the best.
October 6th, there's a full moon, a harvest moon. Could this moon affect October markets?
I'm always looking at the lunar cycles as as a change of direction time frame. So there's also a new moon coming up about 10 days later. So I think it's on the 11th or 12th of the month is another. That's the new moon coming up. So around these time frames, within a day or two, sometimes you get little change of direction. So you got the 6th coming up here on the full moon. And, that's just coming up early next week on Monday. So let's see what happens. Maybe we'll get a big change in the market on Monday.
What are you seeing in geocosmics?
On the solar flare front, there's some minor storms due, according to the analysis at spaceweather.com. So there's some high-speed, they say, stream of solar wind heading our way, but they're not calling it, super strong. They say it could get a little stronger. We haven't seen, you can read the whole article. There's some magnificent auroras being produced in the Arctic Circle, according to the report. So there's always a stream of, they call it G1 class geomagnetic storms that create the wave of energy that passes over the Earth. And the big issue, is whether we see some significant sunspots unfold and whether they start pointing to the Earth. So that hasn't happened. So that I'm not holding my breath here. I guess when a big one hits, it'll probably surprise even the scientists. Because we are seeing streams of solar geomagnetic storms, energy from the storms, that is, passing in our direction over time. So it's funny that we did see a lot of activity just early last week, though. Just as that Rosh Hashanah came in, there was a high activity of the solar storm activity at that time. So, you can pay attention to the stuff or ignore it. If you can tie everything together in your own mind, and if you're trading the markets, it becomes important. Otherwise, it's just casual conversation. But I enjoy talking about it, but nothing significant that I could report at the moment.
Electronic Arts, a company started in Vancouver, Canada, was bought out this week by Jared Kushner and private equity for $55 billion. Any thoughts on why they wanted to buy EA for $55 billion?
Well, EA is the home of some of the biggest gaming franchises in the world. Madden, NFL, for example, another one called Apex Legends, another one called Battlefield, another one called The Sims, etc. So, IP in gaming has strong leverage, has merchandising, licensing, and film adaptation possibilities. And, Jared is a smart guy, and, they value that around $55 billion. I think they're doing the deal at $210 a share with a 25% premium over the current share price. And their plan is to take EA private. So I guess they'll take it private, build it up, and it'll go public again at some much higher multiple in a few years. But it owns some really, very popular and profitable franchises. So makes a lot of sense to me.
Elon Musk hit a net worth of $500 billion. Do you think he'll buy some more media like he did with Twitter, now known as X?
Who knows what Elon's going to do? He's an amazing guy. I mean, all I can tell you is that in the last few weeks, they thought Tesla was going out of business, or its stock had dropped to a very low price. And let's see, where to get to exactly. I have to pull up the chart here myself. It dropped. It was in the high 400s, and obviously Elon got involved in the political spectrum, which people were not too excited about. But late last year, it got up to about $488 a share. Then it collapsed to $214 a share, and now it's almost back to its highs. It got as high as $470, I think, today. So it's within a few dollars of its record high. I mean, I could see this as a $1,200 stock in the years ahead, with robotics, what he's working on, all kinds of other projects. He's got SpaceX. The man is just an infinite source of new ideas and technological innovation. So your question is whether he'll spend more money on, other media and so forth. There's no way of guessing what this man is going to do, but he's obviously been right. And he's still, if not the wealthiest man in the world, the second wealthiest man in the world. And I've been a big admirer of his for the longest time, just by virtue of his successes and the creative projects that he has come up with. I mean, who else planned a trip to Mars other than Elon Musk? I mean, just think about that. I mean, who else had the ability or the foresight and the creativity to do something like this? And I'm sure that's only part of what he's imagining for the future. All I can say is I wish him health and long life, because he's been really a big boon to the technology and to the human race. And what he did with the automobile alone, with the Tesla vehicle, and what that did for the industry and in itself would be a life achievement. And that's one of many things that he's worked on.
Mark, thank you so much for being on This Week in Money. Can you tell us where our listeners can follow you and subscribe to your newsletter?
Sure. VRTrader.com. That's VRVictorRobertTrader.com. And again, as you mentioned earlier in the show, and I offered the discount that's still available, 50% off to any new subscriber using the promo code half off, just half off.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Martin Straith, and Mark Leibovit. And thank you for listening. If you have any questions for our show or for our guests, you can send them to info@HalfStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.